In this video, I will demonstrate how an accountant uses the worksheet in order to summarize business transactions and make sure everything is in balance, hunky-dory if you will, prior to preparing financial statement. For example, now let's take a trial balance of a particular business. This is the worksheet. We start off with the trial balance, then we have a columns here for adjustments. Then we come to adjusted trial balance, then we sort the accounts into an income statement and a balance sheet. So, you see, to begin with, these are the balances in the accounts at the end of this particular accounting period, and we are balanced, $28,007, $28,007. Now, here are some of the adjusting entries. As of October 3rd, the 1st, debit supplies expense and reduce the asset supplies. Debit the insurance expense and reduce the asset prepaid insurance. Debit depreciation expense and credit accumulated depreciation. Debit unearned service revenue and recognize revenue. Debit accounts receivable and recognize revenue, and so on. Now, once we journalize these, we then post them right here, right to the adjustment column. A was a debit to supplies expense and a credit to supplies. B was a debit to insurance expense and reduce the insurance. C was a debit to depreciation expense and a credit to accumulated depreciation. So we post all of these in these columns prior to putting them in the actual records. This is just a test sheet that we use to make sure everything is balanced. So we know the adjustments are equaled, so we can be reasonably sure we carried that off. We now summarize them. Cash, $1,520 debit in the trial balance, no adjustments, so we move it to the debit in the adjusted trial balance. Supplies was a debit, $2,500 in the trial balance. There's a $1,500 credit, so that's subtracted. And the $1,000 is carried over here to the adjusted trial balance. Equipment, prepaid insurance was $600. There's a debit. We've used up 50 of it, so the actual balance now is $550. So you see how we put this all together. Down here, we've opened up new expenses that were not there before. This was our trial balance up to here. Well, here's supplies expense. So it's moved over here to the expense column. Insurance expense. Accumulated depreciation, interest expense, accounts receivable, and so on. So now we add up the debits and we add up the credits to make sure that they are balanced. The next thing is to sort these accounts as to what belongs in the income statement and what belongs in the balance sheet. So we start with the income statement. Well, the income statement is revenue. Now watch that unearned service revenue. That's not an income statement account. The revenue account is 10.6, and it's right here in the adjustments. We don't go back, we just use the adjustment. The adjusted trial balance, so we know that this is correct. So we move the service revenue over here. We move all these expenses over here. That's all we're doing. So we have on the credit side of the income statement, revenue, and on the debit side of the income statement, expenses. We don't balance. Our debits don't equal our credits. Well, that's good, because you see the credit is revenue, the debits are expenses. So the fact that the debits are less than the credits means that we had a profit. Alright, so we don't worry about that now. We next do. So all the others now are moved over to the balance sheet. They were assets in the adjusted trial balance, and they are assets in the balance sheet. We put them all together, we summarize, and dividends is brought over here too. We put it in here, and lo and behold, the debits are greater than the credits. It does a balance in the balance sheet, but you see the difference here is the same difference as here, because this is the net profit, which we have not added to the retained earnings. Retained earnings is at the beginning of the period. We have not added the profit that we have earned here. But once we've added that profit, then we know that the balance sheet will, and the difference here is $2,860. We add that to the debit side of the income statement to make this balance. And that's exactly what we need on the credit side of the balance sheet to make it balance. So therefore, when we close all these accounts, which is the next video, into the capital account, then the balance sheet will balance. And that's how an accountant uses the worksheet to summarize all of this data. Okay, this is just a small company, but you can see how valuable it is to make sure step by step we are in balance and we're moving things properly, and then when we are out here by the same amount that we're out here, we know everything will work.